Hello, everyone. I'm John Seroka with Seroka Brand Development and also the Mortgage Technology and Marketing Committee Chair. And welcome to our very special webinar today, featuring some of the very best of the Digital Mortgage Conference presented by National Mortgage News. You are all going to be so happy you joined us today. We have some great speakers from some truly remarkable companies with us. I personally couldn't be more excited to have them here. So be sure to write down all your questions as we move through this webinar, because we'll have a Q&A session at the end. And before we go any further, I want to give a special shout out to Dustin Hobbs, the communications director at the California MBA, who worked so hard to help put this together today. All right, so the innovation that has taken place in the industry over the last few years has been truly groundbreaking. It's been led by great thinkers and entrepreneurial minds and spirits, building the technology that is transforming our industry and how we do business. They've created great efficiencies in the mortgage manufacturing process that have resulted in a much better borrower experience and also help lenders achieve great savings. So I would like to introduce to you our panel of speakers. First, Sanjay Kuttemperoor, founder and CEO of WikiRealty.com. And second, Paul Wehrley, consumer president of HouseCanary, and Erin Watts, the VP of product strategy at Guild Mortgage. By way of some background, this webinar is a production of the Mortgage Technology and Marketing Committee. The committee was formed to support the development and dissemination of new technologies and marketing strategies that the mortgage industry needs to embrace. As we go through this, please submit your questions again, and I will direct them to the right individual as they come up, or you can wait until the end, and then we'll have the Q&A. So we have some exciting people lined up today, so let's jump right in. With that, over to you, Sanjay.
Thank you, John, for the kind introduction. I'm just going to go ahead and share my screen at this point. Dustin, if I'm assuming you can see my screen, but once again, we're happy to be associated with the California MBA and to be speaking with all of you today. I'm the founder and CEO of Wiki Realty. I'm actually joined with Lester Nare here, who's our Chief Marketing Officer as well. So he's going to be available for some of the Q&A at the end. So what do we do here at Wiki Realty? In a nutshell, we are helping loan officers connect with consumers at the very beginning stages of their search process. You know, we sort of top of the funnel, so to speak, helping them really stay top of mind with people in their market that are interested in real estate and really becoming a part of the conversation. As all of you know, the industry's changed quite a bit, and you need to be a part of the online conversation today for any new business relationship. And you know, we too just returned from the Digital Mortgage Conference, and this was really one of the prevailing themes. You know, how do you connect directly with the consumers at the beginning of their search process? And this need is particularly, you know, highlighted by the fact that the large industry players, you know, the Zillows of the world on the listing data side and on the loan side, you know, the players, the Quickens, the Rocket Homes, you know, with their huge advertising budgets. And, you know, they've really sort of democratized the, you know, what we like to refer to as the quantitative side of the business, you know, making property listing information and access to, you know, online loan processing very easy. So, you know, how do you have to be sort of thinking, how do you as sort of the local loan professional compete if you're not one of these industry giants? And, you know, the good news is, and this is what we're going to talk about today, is, you know, online strategies will help you ensure that you stay relevant over the long term. And, you know, sort of taking a step back, we, you know, at Wiki Realty, we started working with realtors on the same question, you know, how do you stay relevant in your space? And over the last 90, 120, 180 days, we've been hearing quite a bit from loan professionals that really have the same pain points. You know, you're tired of waiting for business to be referred to you from a realtor or someone in your referral network. You know, how do you sort of connect directly? And, you know, on our side, we've really seen an industry shift, and that shift has become, you know, very apparent, you know, that consumers are adopting what we like to refer to as a loan officer first strategy. That is connecting with the loan officer first, as opposed to, you know, what was traditionally, you know, in sort of traditional ways, you know, the realtor first. This actually makes complete sense to us, and I'm sure to all of you, because look, if the buyers don't have the money, they don't have the funds, they're not going to be able to buy the property, right? So this makes a lot of sense to us. So where is the opportunity? It's really about forming strategies around building trust and relationships, because many of you know this today, consumers just don't want to be sold. And I really like the substance of this slide because it drives home another point that we continue to hear at the Digital Mortgage Conference. And it really centers around this concept. Brands that focus on delighting the customer early on will dominate the marketplace for years to come. And many of you are probably used to, focusing on this part, what we call the property search and closing, 60 to 120 days after a property is identified. Based on where we see the industry today, if you focus only here, I hate to say it, but the likelihood is you're going to lose business over time, and you run a real risk of not staying relevant. This is where the opportunity is. When people are thinking about a move, sort of the neighborhood search process, and 9 to 12 months out before even a property is identified. And if you focus here, and this was also said over and over at the Digital Mortgage Conference, you will dominate the market. So how do you do this? The consumer process has really shifted to finding a neighborhood first and the property second. And these infographics, we think, really speak volumes. 80% of the property buyers out there say that neighborhood information is the most important factor. And then in terms of connecting with a professional, market knowledge is what consumers are looking for. Hooking up with a professional that understands the nuances of a neighborhood more than the traditional personal referral, agent reviews, or broker reviews, loan officer reviews. This is where you need to sort of focus your efforts. So if you understand these fundamentals, it's easy to understand that professionals that share these kinds of neighborhood insights are going to be the ones that build the trust, build the relationships. And this is where we like to say, sort of jokingly, we're Tinder for real estate, right? We help consumers figure out what neighborhood they want to live in, and then we connect them to the best real estate professionals. But obviously, today, the way we view it, there's some roadblocks in terms of how you as a loan professional are going to capture this opportunity. We saw a lot of great tech at the Digital Mortgage Conference, but from our perspective, a lot of it addressed how to deal with leads once they are in your ecosystem. Nothing really sort of addressed how to get them there in the first place. That was one of the pain points we saw. And then most loan officers don't have the ability to be associated with local property listings. I mean, unless you're one of the industry giants, you don't have the ability to be associated with consumers' home searches. We give you that ability. We're a national platform. We have 1.7 million listings. We have the ability to marry your brand, your loan officers with properties for sale in your local market. And then there's this last piece: content marketing, understanding Google, social media. It's a head scratcher. We understand it's not what you do. This is what we do. We help with all these strategies on Google, on search engines, on social channels, and we help get you found. We understand that you don't have the time, you don't want to, or candidly, you just don't want to do it. So we really help take over all those functions for you, and then we marry you to property listings in your area, and really help you sort of stand out. And this is really the first step to building new relationships online, which ultimately leads to new business. I mean, the data is in. Loan officers that are active online generate more business every month. Here's an example of what we've done for a bank actually in the Midwest. Over a 30-day period, they had 10 loan officers, and we think this is pretty amazing. They reached over 30,000 people. 30,000 eyeballs saw their brand, their loan officers' identity, with over 2,000 clicks over to their specific content and to their brand, and 280 people to connect with. This is how loan officers are actually getting results. And then we have a follow-up strategy where once you engage with these people and you've gotten their attention and you're top of mind, we then go back to the same group with your direct business message, your product, your offerings, and send them that same message to the same target audience, but once again mixed with content that matters to them, the real sort of value add. So it's a really interesting content cadence where you're getting in front of people in your market with content that matters to them, and then you're giving them your direct business message, once again married with this content, and then you're giving them content again that matters to them. So you're really engaging with them, and it's a pretty powerful combination, sort of a 1-2 punch that really helps you sort of stay top of mind with people in your market, and really makes them want to connect with you and form a relationship. So at this point, I'm just going to dive in, just show you our platform, really show you firsthand what we're able to do. As I said, we're producing this great content based on the market you want to focus on, and we are allowing you to cast a very wide net on Facebook, Twitter, LinkedIn, on Google. Here's an example of some of the engagement we're getting, and sort of highlights why this content is so important. Over 4,000 people reached on this specific post, 381 post clicks back to this loan officer's piece of content, 204 reactions, shares, just amazing stats. And so what are they doing? What's the journey? The customer comes in through Facebook in this case. They come in, they see this content, it's branded to the bank. All of the calls to action lead to this loan officer. If the consumer is interested in understanding financing options, they can connect with him here. We show this content. We have a link back to his website, a lot of other great content that matters to consumers. This is real world stuff. This is what people care about. And then property listings. The loan officer is able to marry his brand once again with local property listings. Here's an example sort of closer to home in Los Angeles with the loan officer here. This is the same kind of data that you'd see on Zillow, TruliaRealtor.com, and you'll notice that the loan officer's brand stays consistent with the content that we have written for him and other local content in the area, and once again, property listings. And we've got examples like this for content all over the country. We posted about a new Ross coming to Los Banos. Once again, great engagement. Here's another example. Actually, this just came in sort of fresh off the presses yesterday. We wrote about this new Sonic burger. I mean, check out the engagement on this. This makes the loan officer or the realtor, whoever it is, really stand out as the local expert on social. And I also mentioned Google, and I'm going to show you this. If you remember this Los Banos post here, tremendous engagement on Facebook. We are also getting to the top of organic search. Almost 2 million results. If you type in the query, you folks can try this on your own, on your mobile devices, wherever you are. We are surfacing to the top of search for lifestyle-related queries. Is Elm Grove a good suburb? This is how consumers are searching. And once again, almost 2 million results, and we are at the top of search. Most real estate professionals don't have the ability to do this on their own. We are seeing these results because we have authors all over the country contributing this content, linking in, linking out. This is a formula that the search engines like, that Facebook likes. What I'm showing you here is an example of organic search in Facebook. I'm not sure if many of you know, but Facebook is becoming its own search engine. Over 2 billion searches on Facebook last year compared to Google's 3.5 billion. So Facebook is still becoming its own search engine. And look, we're also surfacing on Facebook search as well. Yard House Naples, we're dominating the links section. And once again, type in Yard House within Naples and over almost 10 million to 9 million results. And we are right under the Yard House restaurant's own website on the first page. So look, these strategies, content marketing, are known to produce 3 times as more results as traditional advertising, a fraction of the cost, and it has tremendous longevity. Once you put content online, it's out there forever. Unlike paid ads, when you stop paying, those ads go away. That's why you see companies like Coke and Geico and Nike. You don't see Nike putting out commercials that says, hey, buy this pair of Air Jordans. They're selling lifestyle. And this lifestyle strategy is one that is now permeating real estate. And as loan officers, it's your opportunity to sort of become that neighborhood expert, stay top of mind across search, social, And on Wiki Realty now, we can marry you with property listings. So it's a pretty holistic platform. And we are working with individual LOs and enterprise solutions for organizations. And I'd love to talk with all of you on the webinar about how we can work with you. And you can reach me directly. I mean, we're pretty accessible. My email is Sanjay, S-A-N-J-A-Y, at wikirealty.com, wikirealty.com. So hope that was okay. And John, I'll turn it back over to you if there are any questions.
All right, Sanjay, thank you very much. Oh my gosh, that is such great information. Excellent presentation. Quick question that came up here for you, Sanjay. You mentioned a content cadence approach, and could you speak a little bit about that? Mixing in content with the direct business message.
Yeah, absolutely. So, the first thing we do is we put out lifestyle content, as I was sharing with you here. It really sort of gets the consumers interested. It generates a tremendous amount of interest, and people are interacting with that content, as I shared with you here. A whole bunch of folks are liking, sharing, commenting. We're gathering all of that data, and then, with that data, we are able to retarget those folks and share with them your specific business message. If you have loan products or whatever your specific business message might be, we will then get that message out to the same group of people, but once again, married with all of this great content. So they don't feel like it's a hard sell of, hey, closing costs are down. It might be, closing costs are down, and oh, by the way, did you see, this new street fair that's going on in Sherman Oaks? So it's really sort of a great relationship building tool. So we start with the lifestyle, and then we go to the business message, then we go back to the lifestyle, and then the business message.
All right, great. Thanks for that explanation. With that, over to you, Paul.
Hi, guys. Great job, Sanjay. And John, thanks for the introduction. I'd like to introduce myself. I'm Paul Wehrley. I'm the consumer president here at HouseCanary. I'll give you a little, as far as how I'm going to parcel up my time. First, I'm going to talk about an intro to the company so you know who we are. I'm going to dig into the problem that we're out to solve as a company. I'm going to talk about how we solve it, and there's some cool sort of new tech that we're using to do so. And then I really want to spend a few minutes talking about the future that this solution could enable. So with that, I'll get going here. So what is HouseCanary? Really our objective, we are automating collateral valuations so that people can make better real estate decisions. It's that simple, and I'll get into some of the details. The company itself, we're about 4.5 years old, raised a fair amount of money from some clever people. Eric Schmidt, of course, former chairman of Google, Alphabet, Penny Pritzker from the Chicago Pritzker family, a few institutions, Egon Durbin, Run Silver Lake, folks like that, believe in what we're doing, and we're excited to have them on board. I'll get into more detail on sort of how accurate we are and things like that, but truly there needs to be a step change in accuracy in this industry in order to accomplish some of the things that we set out to do, and particularly the envision and actually make actionable the future that we envision. So what is it that we're out to do? So the problem, first and foremost, is collateral valuation traditionally in underwriting especially is expensive, and it takes a long time. The average appraisal, if you think of say a 40, 45 days, something like that, transaction close, an appraisal takes 20, 30 days. And frankly, in certain areas of the country, say the Pacific Northwest, it can be 5-6 weeks. And people miss rate locks and transactions, if the home doesn't appraise, you're back to square one. It's very time consuming. It's a tough thing to get through at times. So we're out to attack this. It used to not matter quite as much, I think, when your 3 C's of underwriting, credit, capacity, and collateral, when credit and capacity took equally as long, but now those are largely solved problems. Credit can be handled with an API call in a matter of milliseconds. Capacity, really smart folks out there Forbes, Finicity, other guys like that are doing capacity checks for asset income, employment in a matter of minutes online. And so the collateral piece still hangs out, and we're gonna focus on how we fix that. The other piece to collateral valuation here, and the next two slides are directly from a Fannie Mae presentation, is that they are tremendously confirmatory at the contract price. So what it's telling us is when an appraiser gets a contract price ahead of time, lo and behold, 96% of the time, they come in at or above the contract price. And so these are not objective valuations. They're highly subjective. Here's the data below. So Fannie ran, appraisals post-contract where they gave the appraiser the Rep C, and you see this giant spike here on the right, and then the same data set on the left when they were not given the Rep C, and you see where it comes in there. So we're really out to attack the time, the cost, and the subjectivity that we see in appraisals. So how do we do it? PowerPoint 101 here. I'm going to give you guys a pyramid and talk bottom up here, but first and foremost, we license in tons of data, anything we believe that can affect the pricing of residential real estate in the U.S. We perform some pretty high-level valuation and analytics on top of that. We build that, both the data and the valuations, into software, and we get that software in the hands of our customers. And frankly, one of the great things about doing that is we get data back from them when real estate professionals use our software. We get that feedback loop back, and it adds back into the data. And finally, the top of the pyramid here is transactions. We can really affect transactions in a positive way, meaning they're more likely to go through at lower cost by using our stuff. So I'm going to pick each one of these apart a little bit. On the data side, we license in hundreds of data sets, hundreds of millions of endpoints, things you would totally expect at the household level, like we have a full national public record, so 3,200 counties, county assessor, county recorder data. We partnered with over 400 MLSs, so we've captured probably just under 90% of all the listings that are listed in the United States. We'll get MLS direct feeds on that, which are refreshed, 15-minute basis. Macroeconomic data, microeconomic data, things like crime in schools, all this we'll license in. We rigorously clean it and normalize it, and that allows us to do cool things on top of it. I'll show you a couple of the more eye candy things here. One is we're big users of machine learning. One thing we've been doing lately, we're trying to attack a couple of the problems that typically are ignored by automated valuation models. One of them would be, how nice is this property with respect to special features like views and privacy. So we've laid the plat maps, so the parcel boundaries, on top of topographical features and imagery, and then we can determine the angle out your front and backyard. The view angle, what you're looking at. Is it something accretive to value, like a golf course or the ocean, or is it something detractive of value? We can determine if you look down on your neighbor, or if your neighbor looks down on you. And this all affects value. Similarly, we use machine learning to look at imagery. So this could come from MLS, it could come actually from users uploading photos, it could come from a host of different factors. But on the top there, we're taking interior photos. There's two different properties on the left and the right, and the machine is grading them by property quality. And we've got 11 grades. You'll see in the one on the left, it's coming in as awesome. On the one on the right, it's coming in as actually bad, and the low end of bad. In the middle there, we can actually identify, we're looking to use machine learning a level down and identify features of your kitchen. So we can tell the left photo has, granite countertops and Miele appliances. And on the right, you've got a Whirlpool range and you got laminate. So that will all go into value. And finally, we can do the same thing on the exterior. We can spot condition issues. We can grade properties. And so you'll see on the left, 0 issues, and on the right, we've got major issues. It's a boarded up home. And all this is done without a human ever visiting the property. And how this bears out, it bears out in the data itself. Our Our valuation models come in, second to none in the industry. We have a 2.7% median absolute predictive error. It's the most accurate single source model in the nation. That's across almost 107 million properties, so virtually every single family home in the United States. And we're continuing to innovate here, and the work we're doing on the machine learning side will bear itself out. And we hope to be, sub 2% error nationally by 2019. We produce forecasts as well. This is critical, particularly for investors, for lenders. And we do them at the block level. This is really important because you see a lot of forecasts at the MSA or at the zip level, and that tells only part of the story. On the left is a graph here, a block level graph of, a chloropleth of blocks in San Francisco. And just a couple blocks over, you're going to see an area that's growing at 5%. And then a couple blocks to the right, you'll see something that's stagnant or actually decreasing in value. And so block level stuff really matters. And we have sub 1% error in our 1-year forecast. Another great thing we can do is take the valuation information we've got and combine it with the loan details we get from our public record. And then we get really a picture of the balance sheet of most Americans. And so this is just that. We know what loan somebody has, and we can tell if they are better off with another product, how much they'll save, and then we can refer them to somebody to get a loan. We can use this information to market to folks. So it's very powerful. And finally, before I talked about how we create this data and then we bring it to market by incorporating it into, or often incorporating it into software. What we've got here on this little graph, left to right, is fully automated products on the left end, and then human-driven products on the right. And there truly is a spectrum of stops in the middle where you're combining maybe an inspection where you send somebody out to take photos of a property with models, computer models that will take that inspection, can take the condition and the photos that the inspector decides are appropriate for that home, and incorporate that into our valuation models. And so we end up with FIREA compliant and IAG compliant valuation and evaluations throughout. The cool thing this does is if you can bring all this information together and arrive at a standard valuation at scale that's highly predictable and highly dependable for residential real estate, this is sort of a FICO score idea, right? You get a FICO score for properties, and it allows you to unlock a lot of liquidity across various levels inside of the housing economy. Future-wise, where do we see things going? If we can build these, highly scalable, highly accurate models and give collateral valuation at scale, we can do some special things. So this is another comment from Fannie Mae. This is from the presentation that I showed you a couple slides earlier, saying we should be working toward a spectrum of valuation solutions appropriate for the risk, collateral, and valuation of the home or loan. What we see today is that it used to be, you had to get an appraisal, period. That was 100% of the market. Fannie and Freddie have introduced their appraisal waivers in certain circumstances. That's PIW and ACE in their parlance. And, they fit a small segment of the loan population here, about, 10%. That means 90% still have to go to appraisal. But, think of a homogeneous area where you have a lot of comparable sales. The homes are all around the same age. You shouldn't necessarily need an appraisal in that situation. And so we're working toward this spectrum of valuation. You got AVMs on one end or waivers, you got full appraisals on the other, and sort of what happens in between. And this is where we can come in and we have some of these products that are either automated, partially automated, or full human driven, where we want to evaluate the risk to that property, the risk from the borrower, and then plug in a different valuation product depending on those circumstances. We've also got an insured product there as well. And really, this should allow us to unlock a lot of liquidity in the market, speed up transactions, reduce cost, increase certainty. And this can all happen, over the very short period of time, depending on, Fannie and Freddie. Another cool thing that this does when we look a little further out is, and I'll get into this by explaining, to more of a layperson's view of how home financing works now, just in terms of order. A realtor will list a home, or a buyer will list a home, and not a lot happens until they receive a bid on that home. After that bid is received, then the financing process kicks off, where you do the valuation, you search title, you put the financing in place, and then you have a closed loan. It takes 40 something days. If you've got reliable valuation products up front that the capital stack believes in, you can rearrange some of these pieces and rapidly unlock the liquidity here. So at time of listing, I'm actually also going to do the collateral valuation. I'm going to run title. And if you've got those in place, you can arrange for financing before the buyer's even known. Now, this financing would be subject, of course, to the buyer having a certain credit score or capacity threshold. But in that instance, a buyer could come in pre-qualified, the home is pre-financed, and they could drive it off the lot in something like 5 days. What this means is we move from an area of pre-qual, like you may qualify, to you are qualified. And when you're browsing for homes, you actually see homes that you're qualified for with a buy it now price, for lack of a better word. So that's really what we see, how the industry going and how we can help it out, really unlocking transactions on the lending side and the cap market side by using these valuation products, and then building a platform where every home is instantly searchable and valued, instantly financeable, and always for sale. So with that, I'd like to thank you guys for the time. If you're interested in partnering with HouseCanary, it's easy to find me. I'm paul@housecanary.com.
Great, Paul. Thank you very much. And we have a minute here before we have to move over to Erin. And a question came in for you. This is from Shannon. The question is, Paul, how do you incorporate home builder sales data in areas where they are exempted from reporting through MLS, especially important in areas of new construction?
Yeah, we reach out directly to the home builders, and we have relationships with some, certainly not all, but some, particularly the larger folks, where we get direct feeds of their inventory.
Great. All right, thank you. And some other questions came in here, but you know what? I want to move this over to Erin next, and then we'll have some time at the end to cover the other questions. Over to you, Erin.
I'm good, thank you. Sorry about that. Yeah, thanks so much for having me today, and thanks for CMBA for reaching out and having me join today. I want to take a little bit of a different approach within my presentation. Sanjay and Paul have great products, and I think that they're very invaluable to our today's market and kind of our future market of 2019. So I wanted to talk a little bit about, well, I run products, so I wanted to talk a little about, kind of what we foresee for products in 2019, as well as technology that we see. So go ahead and get started. So a few of the products that I want to talk about today, there's tons of products, but the ones that I feel are really pertinent to today's market and to the market for 2019 are new and old products. I want to talk about disaster products with all of the disasters we've recently seen with fires and hurricanes and flooding and all of that. Very important to have these types of products to offer to our buyers. Also want to talk about renovation and construction, non-QM, and a little bit about gig economics. So to start, I think it's really important, kind of Guild in our perspective is being able to serve the home buyer. So we want to be there and be able to have a product out there to help everybody. So something that we have found is a really great product is the FHA 203H Disaster Relief Program. If you've heard of it, great. If not, and a lot of people haven't, I just want to talk a little bit about that. So what this program allows for you to do is, if you're a borrower is involved in a presidentially declared major disaster area, and let's say they already have an FHA loan, with this program, they would be able to purchase an additional FHA loan with 100% financing. And with that program, they wouldn't have to include the payment of their current home in that loan, as long as they were working with their mortgage servicer and as well as their insurance companies to resolve that mortgage debt. So something I just wanted to bring up, I think it's really important. You know, it seems like every couple months something new is happening. So I think that this is definitely something that I wanted to bring awareness to. So next on to renovation and construction. You know, I'm sure most of you have heard that right now renovation and construction are huge, especially with our low inventory and borrowers not being able to find homes. So, you know, with a flourishing economy, you know, that it equals increased rates. So although the rates are increasing, interest in buying, especially for first-time home buyers or for someone that maybe is moving with a new job opportunity, are really high. So we're going to still see an increase in renovation loans even with increased rates. So these buyers will purchase a home at an increased rate to ensure that they are able to purchase a home that they need in the community while the market still is experiencing low inventory. So it's really important to offer these products that appeal to these borrowers. So due to the low inventory, renovation and construction loans are on the rise and will continue to be for a while. We're finding that many buyers want to purchase a home in an area that they work or go to school in. Because of this, realtors should not be afraid to market a home that is just not so perfect. Renovation loans can generally find a borrower a home that is in their price range in an area they want to live and give them the ability to make their home their own. We also feel that there's a strong connection with emotional attachment to their home and a lower risk of early payment defaults. So something to always consider with these buyers. So in 2019, as we're seeing rates increase, you know, I think that the purchases will continue to keep going, but refinancing a current home will probably slow down a bit until you know, rates start to drop. And then everything that we've looked into and read from statistically shows that, you know, construction is going to be top of mind for at least the next 5 years. Okay, so now on to non-QM, or, you know, QM is qualified mortgage. So at Guild, we do call these expanded loans. So a qualified mortgage is a loan with a standard set by the government. The term non-QM is for loans that don't have the characteristics, that don't typically meet qualifications for the income calculation, but really it can be any type of qualification that's not standard to the norm. This loan type has become very popular with new types of income and employment types that are not yet recognized in typical underwriting. So you do have to be careful when you're selecting non-QM programs for your company. There are some bad actors out there that will go much further than more expanded criteria like we do at Guild. So if it seems too good to be true, it most likely is. So, you know, an example of that could be very low credit scores, you know, sub 500, with DTIs over 55, 1 day out of bankruptcy, you know, all those features combined can definitely be trouble. So, you know, it's absolutely up to your risk teams at your company to determine what type of business you will accept. So our philosophy is low risk while providing products to borrowers with interesting income scenarios. Some products that have done really well and fall under non-QM are the bank statement programs, interest-only loans, non-warrantable condos, and RSU income. So that would be restricted stock units. So our bank statement program, this is an example of our flyer that we have out for our borrowers, is, you know, our bank statement program is for self-employed borrowers. So what they do is under these bank statement programs is you typically gather between 12 and 24 months of bank statements. And then the income can be calculated based off of the deposits into those accounts. So there are many borrowers that have all these write-offs on their tax returns. And then once that loan is submitted to underwriting on a typical program, it's declined because the tax returns show a loss or whatnot. So, you know, by documenting up to 2 years of statements to show deposits as well as an acceptable credit score, typical bank statement programs are over 700. You know, and for the time being self-employed, you know, this is really a make sense program. You know, of course, with any program like this, you have to be really wary of, you know, other programs that are similar to this, you know, but maybe only have, you know, 1 to 3 months of requirements for bank statements. So, you know, the 2 year requirement, 1 to 2 year requirement for the bank statement programs is consistent with an income calculation. You know, you typically need 2 years of employment income to document income. And so, you know, you should feel some comfort with the bank statement programs having that same type of requirement and documentation just through a bank statement. Interest-only loans. So, you know, interest-only was a QM product until, gosh, it's probably been less than 12 months ago. I think it was deemed and marked non-QM by CFPB, you know, like less than 12 months ago. So loans are a great product, especially for a borrower that may not reside in their home for the full ARM period. So then I put non-warrantable condos on the list. You know, even though this is not an income-driven characteristic, with a lack of inventory, you know, condos are going up very, very quickly. So, you know, many times condos are going to be deemed non-warrantable. You know, if like the investor concentration is really high and they maybe haven't sold as many as they need. So instances like this is where we're finding that non-warrantable condos are a really viable, good product. Of course, you know, when you're looking at non-warrantable condos, you always want to be cognizant of, you know, if the condo is under litigation, something that could affect the budget of the HOA, you know, things like that could be very risky. But, you know, it's, again, you know, up to your risk team's idea of what they would find under their risk threshold. Okay, and then RSU income. So an RSU income is another program that we've seen a lot of requests for, a lot of feedback of, you know, who does this, why are we doing this? So, you know, part of Gil's footprint is in the Northwest, so that's where Amazon is located. So, you know, I don't want to botch the definition of RSU, so I actually looked it up, and I'm going to give you what it says from Investopedia. So a restricted stock unit is compensation issued by an employer to an employee in the form of company stock. Restricted stock units are issued to an employee through a vesting plan and distribution schedule after achieving required performance milestones or upon remaining with their employer for a particular length of time. RSUs give an employee interest in company stock but have no tangible value until vesting is complete. The restricted stock units are assigned when a fair market value when they vest. Upon vesting, they are considered income, and a portion of the shares is withheld to pay income taxes. The employer receives the remaining shares and can sell them at his or her own discretion. So, typically, RSU income can only be used as income if the borrower has been vested with a company for at least 2 years. In recent months, many investors are allowing RSU income with companies like Amazon to be allowed if it's shown in their offer letter. So this is something that we can do today. New employee with Amazon, RSU income showing, we can use that calculation. So typically what's going to be required is that vesting schedule that I mentioned, and your underwriter will typically do worst case. You know, if they're there for 12 months and they get, you know, 5,000 shares or whatnot, and they leave after 6, they only get half. That's kind of, they go off of worst case to provide some clarification. Okay. And then, so a little bit more about a non-QM loan. So, we're finding that non-QM is becoming very typical in today's market, just with the different types of borrowers are out there with self-employed, RSU income, as we mentioned, different income types. So typically a non-QM loan is going to fall under an investor with their jumbo program. So with a jumbo loan program, typically, you're going to have those main requirements of 2 years tax returns, income, the rule of 2 for everything across the board. But with these programs, the loan amounts vary all the way below the jumbo loan amount. So we've seen them offered as low as $100,000 loan amounts. So, and a little bit of a higher rate. And with any type of super niche program, the rate will be reflected based off of the eligibility. Okay, so just wanted to talk quickly, not quickly, but just briefly about gig economics. These are going to be our borrowers of tomorrow. So what's a gig economic job? So it's really just, it's fancy for freelancer. So it's just someone that or is a short-term employee, short-term employment. So right now the gig economy is hot. Like jobs could include Uber drivers, Lyft drivers, Instacart, or any type of grocery delivery, Instagrammers, YouTubers. It could be short-time coders for computer programs. The list goes on and on and on. I'm sure in the locations that you're in right now, you probably can think of quite a few more than I just said. So, Freddie Mac actually did a study on this and noted that 43% of workers will be freelancers or gig by 2020, which is a huge number. So, recognizing that now, agencies like Freddie Mac and Fannie Mae are working to do, their due diligence and trying to understand the best way to do qualification. So it's like, but right now we're in an era where we're like, well, how do we do that? So, how do we qualify a borrower that probably won't be employed in the same job by closing? So, again, it's a difficult task and something that, Guild, that we're working on as well as the regulators are trying to figure out. I would forecast that probably documenting these borrowers will eventually fall under some type of bank statement program. If we see that they're doing this type of employment for so many years and documenting, the deposits into their account, for me, I feel like it's a make sense program for a borrower that is a gig employee. So with that being said, technology is most likely going to be the answer, whether they use some type of asset verification or, some way, if they do some type of tax return verification through technology, that really will be the answer. So I know we were here today to talk about technology and everything that we did at the Digital Mortgage Conference, which is great. And Sanjay and Paul have really provided some really great products out there, especially things that can be very helpful to your business and bringing in more consumers to your door. So for us as a lender, and for many of you, and if you haven't even started to implement that much technology, it's really like, where do you start? So, the borrowers of today and tomorrow, they want technology. At the same time, they want people. So you have to really be able to commit yourself to providing both. So Guild, we stand by being a high-tech, high-touch lender. So, and studies have shown that there are increased approval ratings when a borrower has a choice. So even when a borrower selects technology, we've seen higher scores with personal outreach. There are so many options to implement technology into your business. Again, Sanjay and Paul provide you with some amazing technology options to provide support to your home buyers. And then from an origination standpoint, when I was at Digital Mortgage, we spoke about day one certainty and Guild's adoption of day one certainty. I wish I had a poll so I could see how many people have used day one certainty. I don't know if there's a way to raise hands or not. To something that you can do today in your business, if you are underwriting to DU, is take advantage of day one certainty. It's a great place to start implementing technology into your teams. What day one certainty is by utilizing the asset employment verification, appraisal waivers, all of that will give you freedom from reps and warrants. It will also decrease your origination time by days. So we have found through day one certainty, by verifying assets, we utilize account check, we verify income and employment through the work number. And then we also have the option, it's kind of the cherry on top when you get that property inspection waiver to save weeks and money for your borrower. If you get that appraisal waiver, that's huge. So day one certainty will electronically verify a borrower's income, employment, and assets, shave days off of origination, and really help you build your business. Here is a video that I shared at Day One Certainty. So this is an example of something that we do at Guild to create excitement and to show success stories of what Day One Certainty can do for your business. We have seen in today's market, we have seen our production or I should say our percentage of production increase month over month by utilizing Day One Certainty, and we're building trust with our borrowers and building customers for life. So let me share this video with an example of how we implement technology and people in our business. Make sure I can do this. Here we go.
What is going on, Texas Region 2? Got a guest? Steven Jackson up in Plano. How about that? I asked Steven to join because he really takes advantage of Day One Certainty. We got to keep talking about it. We got to keep pushing it. So, Jackson, you were telling me about this borrower last month, and kind of tell me about the application, how that went.
So it's kind of crazy. Get the lead from the agent, and he's pre-warning me. It's really tough to get her to even apply with you. I said, just tell her to give me a chance. Just a phone call. So Eric, I got her on the phone. She was extremely nice. She was an accountant. She was she's very detailed oriented. Got her basic information and started the application for her. I said, where do you work? So she told me. What I didn't tell her was I was typing it into the work number website while I was talking to her.
While she's on the phone, you're on work number.
I'm on the work number.
Okay.
It's a direct hit.
Direct hit.
So I said, is this your job title? She says, yeah. And I go, did you start this date? She goes, yeah. And I said, do you make this much a year? Yeah. I said, okay, good. Then the next thing is, I said, did you see this email I just sent you? Sure. I said, well, what that is a secure website that we use with Fannie Mae. And I said, it has to do with your bank statements. I said, we need your assets. I said, you've never bought a house. So obviously you've got the money for down payment. You're wanting to put 20% down. I said, is that in your bank now? She goes, yeah. I said, log on. So she logs in, Eric. And when she does, about 2 minutes later, bam, I get this link. And so I said, don't tell me. I said, you bank at Bank of America. She goes, no. I said, actually, PNC. Yes. She goes, but you knew that. And I said, no. I said, what I don't know is this the account that ends in blah, 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 and you have this balance? Well, she was shocked. How did you get that? I said, well, what you filled out, we got your bank statements as well. I said, now, basically, I've got your employment, so let me type that in, the things I told you, and then I typed in her bank information. And after we'd structured the loan, basically, I hit it to DU, and I said, here's the difference. You need to give me a driver's license. That's it. I said, you are pre-underwritten right now.
So what you're saying is you ran this is all while you're on the phone?
All on the phone.
How long is this, 15 minutes?
I was going to say 18.
18 minutes. Under 20 minutes, right? We've run DU. We got our Day One Certainty hit, and he's communicating, I got all your income and assets within 20 minutes of doing the application.
We were done, and we ended up getting that deal. Not only did we get the deal, she even tried after all that. I'm impressed with your service, but let me leave your file open. She gets the contract. Here's the best part, Eric. The sellers had a personal situation where they needed to close faster. She calls me and says, well, can you close? I said, well, that's 11 business days. I said, absolutely. And not only did we close it, but we closed it in 11 business days without any acceleration, without any problem, without anything.
And any documents from her.
Or any documents from her.
That changes the customer experience, people. That's what I'm talking about. Make sure you have your logins, right? Let's use day one certainty. Let's change the experience for our borrowers. We'll close more deals. There's no doubt about it.
Okay, so it's a little bit of an example of something that we do here at Guild, and if technology is new to your team, this is I think a really great way to start and implement and see results right away. Okay, so thank you so much for having me today. Please let me know if you have questions.
All right, great. Thank you very much, Erin. All right, we have just a couple of minutes left over here, so let's see if we can get to just a couple of quick questions from you folks. First one here is directed to, this is for you, Sanjay. You guys have taken a lot of the pain points out of the process, but are there things that individual LOs still need to think about doing once they are on your platform? And Sanjay, if you could, since we've listened to two presentations since then, if you can kind of, get back into it a little bit.
Yeah, absolutely. As I said, our goal is to get you in front of people to help you start conversations. And these conversations are started online through all this engagement on Facebook and or on Wiki Realty. And if people are engaging with it, if they're liking your content, if they're sharing it, they're raising their hands, so to speak, online and saying, hey, we found what you said to be interesting. And that's your opportunity to reach back out to those folks and start a conversation. Thank you for sharing my post. Thank you for liking my post. I've been in this market for X number of years, and follow my business page, and you can learn more about what my neighborhood update. So it's really about we tell you who the folks are. We give you some specific instructions on what to do, and then it's up to the specific individual loan officer to sort of pick up that sort of last mile, so to speak, and carry the ball from there.
Great. Okay, and let's bounce over to you real quickly, Paul. Question for you. How long will it take to realize your vision for HouseCanary?
Well, I think it comes in phases. I think we're already in the place where we can supply collateral valuations to the market that are FIREA compliant, satisfy interagency guidelines for underwriting and for securitization and pieces like that today. I think in order to realize a vision where we could pre-underwrite most homes in the United States, I think that'll take probably 2 more years in order to do that. Need a little help from folks like Fannie and Freddie on the either exemption side or maybe some changes to some of the ways that we generally do business in the area. But I'd probably say, 2.5 years.
Okay, great. Great. Well, that's good to know. All right, well, everybody, if you have any more questions, please go ahead and submit those questions to Dustin Hobbs. Dustin, what is your email address?
Hey, it's right on the screen there, Dustin@CMBA.com.
CMBA.com, okay. Great. I asked you and then you put up the screen. All right. So I want to thank everybody for joining us today. We want to make sure that we do our best to deliver quality content. So I have a favor to ask of all of you. You'll be receiving a survey within an hour. Please take the time to fill that out to let us know what you thought of today's webinar. Also, if you have anything that you would like to learn about in future webinars, please let us know at that time as well. Again, thank you all very much for joining us today.